Hello, hello. It's Amber Johnson with Pillar Real Estate here with Miss Zoe Raithel, the mortgage guru at Cross Country Mortgage. Zoe, thank you for joining me today. So,
Thank you for having me.
yes, ma'am. So I know myself as a real estate broker and you as a mortgage broker, there's a lot of overlap with the questions and concerns that we get with our buyers and borrowers.
Yes.
So Zoe is going to address a few of the most common questions and concerns that we're getting right now in the current market. So we'll start broad, taking it back to 2020, shortly after the onset of the pandemic, and then a couple years forward from there.
Can you believe it's been 2 years of this
No,
business?
no,
Yeah.
can't. Whirlwind.
Yeah.
So that we saw some crazy shifts in the market then, and then now looking at current and the last 6 months changes the other way. So
Yep.
Zoe, what are you seeing in the mortgage realm as far as changes from onset of the pandemic to now, and why do you think those changes occurred?
Yeah. That the question actually stems from now. What the heck's going on? Rates are in the fives now. And so then we kind of go backwards to better explain how we got here. So let me just start by saying here is still really good rates. If you look at an average over the last, 50 plus years, the average mortgage rate is in the sevens. So in the fives is still a really good rate, but I am noting quite a bit higher than what we looked at a few years ago, and especially during the pandemic when we were more in the twos and the threes,
Right.
right? So what happened was once the pandemic hit, and basically, our world as we know it kind of shut down a little bit, right? So the federal government stepped in a variety of ways. You might remember through, helping businesses keep their employees employed with PPP loans,
Right.
helping families with stimulus packages with
Mhm.
money to help them pay their bills,
Right.
helping families with forbearance, meaning you don't have to make your mortgage payment for a while. We know things are going on in the economy. And those are many of the things that the federal government did to help us through to make sure we didn't fall into some great depression where everything was closed down and, a horrible time in the United States. So one of the other things they did at that time was really start increasing. It's always been there for a number of years now, but really increase the amount of mortgages that they were buying through their entities. They're called basically they're sponsored entities of Fannie Mae, Freddie Mac. Of course, there's federal government loan programs like FHA,
Right.
USD, but they increased their purchases dramatically and pretty much told the market, we will buy these as long as you need us to buy these, and we will, and once you refinance and pay them off, we're going to buy some more.
Right.
So when we have confidence in where the loans will be going and who will be buying them, the market really, it helps the interest rates. So interest rates really went down significantly. I'm just going to call it artificially, because the government stepped in and helped us through all of these different means. That was what happened during the last few years. So that worked. All of those, measures helped us get through a very difficult time where businesses were able to get back on their feet as COVID kind of, I don't know if you want to call it settled down, but, got into a regular pattern here. Forbearances, that could go away because people could make their mortgage payments again. So the government saw that they don't necessarily need to be supporting as much and artificially injecting as much support. So in that same way, they've decided, well, maybe we're going to pull back and not buy as many mortgages. And even more so, when people pay off the government loans, we're not going to necessarily reinvest that money. We're going to just let those die and go back to a regular market. And a regular market is more a private mortgage market. The government still buys a lot of mortgages, but they are buying less. And so what has happened from the beginning of the year until now that we're going to a normalized market that is not artificially supported by the federal government, rates are just going to go back to normal. That's just what it is. So it's all shocking to both the consumer as well as your mortgage lender that it goes that quickly, but that's what has occurred. Okay. And so now we've got the higher interest rates, paired with the fact that it works so well, the government's, policies, to help support our economy, that the economy kept rolling and rolling and rolling up. So now we're seeing inflation, meaning prices going up quite a bit. So that has sent the Fed going, well, maybe we should, instead of lowering the rates like we did to help buoy the economy, we're going to start raising the rates. When they raise rates because of inflation, that's to kind of temper how fast the economy is going. So it's kind of a long story, but basically what's happening then is with inflation and then raising interest rates, while that doesn't directly affect mortgages, what does affect mortgages is the piece of that I mentioned, inflation. So now an investor in mortgages needs to get a higher rate of return to be able to make it make sense for them, knowing that prices are going higher for everything they want to buy with their dollars. So kind of a really long story there, but just trying to explain how we got so low and how so quickly we've gone back up again.
Yes, thank you. That was very easy to understand, I think.
Okay, good.
Yeah, no, that makes sense. Thank you. So where do you see rates going for the remainder of 2022, and then maybe looking a little further ahead into 23 and 24?
Yeah, so that where we are now is we're in inflationary times. You might have seen the federal funds rate is going to be, has been bumped up a few times already by the Federal Reserve, looking at doing it again this week. And so what they're doing is they're trying to temper inflation. So that might happen for a few more times. So what happens, what they're doing is they're trying to slow the economy so that prices go down and inflate. But what occurs as well in this environment is as they boost the federal funds rate to have people stop buying so much and slow down their spending, they have run a real risk of a recession, meaning now we're not spending anymore. Businesses are not investing in capital improvements or employee bases because recession is occurring. And from some of the numbers I'm looking at, may already be in a recession. They just don't typically announce that until another quarter. So what does that mean? So as they're raising the federal funds rate, recession is basically on the horizon. All the numbers that I'm reading show this. And so in a recession, though, interestingly enough, what are they going to do? So remember I said, when we were worried about the economy, they lowered interest rates so that we can spur economic growth. Now it got so hot that they raised the rates to slow the economic growth. So now if we slow the economic growth so much that we're in a recession, what will the Feds do? They'll lower rates again. So what does this mean to your question of when might we see lower mortgage rates? So because it takes time for all of that to kind of catch up in the data, we probably in our mortgage world are seeing, rates in the 5s for maybe another 3 to 6 months, but we're all anticipating maybe by the end of this year, definitely by end of first quarter of 2023, anticipating lower interest rates because now we'll be really feeling a recessionary times. Now, again, recessionary times, depending on what you do, the mortgage world and housing actually fares very well during recession. So you can look back again on graphs for 10, 20, 30, 40 years. And that is not a scary time at all. For mortgage rates, they'll go down, and for housing. So we're kind of anticipating the same, we've leveled off here, probably being in the 5s for a bit more, but towards the end of the year and into 2023, looking at probably seeing some better interest rates, maybe in the 4s.
Okay. So you mentioned the word recession, and I think anything that's on the downward trend freaks people out. So what is the definition of a recession? And it's not synonymous with a market crash. It's just, what is your take on what a recession means that can, easily be translated by the average person?
Yeah, basically it means the economy has slowed down a bit, but that doesn't necessarily mean that, we've fallen off the cliff or that we're in a depression or anything like that. It just means that we're, again, just like I'm talking about with interest rates, we're really going to be coming back to normal.
Right.
And so what we've seen is that we do have levers in place through the Federal Reserve in assisting in those times. So But in terms of, recessions, really investment in real estate is a great hedge against that, because you're typically, especially in certain areas, I mean, you and I are lucky we live in a beautiful, very desirable location. So it's always been about location, location, location. But you can invest in real estate here on the Central Coast and be pretty much assured that your investment is strong and more than likely will grow with time.
Right.
Yeah.
Speaking of that, I mean, we have seen a shift in the market, but here on the Central Coast, it's still very competitive. I mean,
Yes.
there's always low inventory here, but the demand is higher than it's ever been. People, we're on the map, so to speak now. People want to retire here, they want to raise their family here, they want to get out of the big city life, and this is the perfect place to do that. So still competitive in many price ranges. We're still seeing multiple offers in many price ranges. So from your perspective, from the finance side, what would you recommend to a buyer or borrower to best position themselves financially to be able to compete and get their foot in the door in a competitive market?
Yeah. So, I mean, there's a number of ways, during the process. So at the beginning of the process, the best way is to be fully underwriter pre-approved. And what does that mean? And how is that different than a pre-qual or something you just go online and type in your information and then you get something out on your own printer that says, oh, I've already been pre-qualified. Right. So when you have a mortgage lender that does a full underwriter pre-approval, that means you're actually sending in, as a consumer, your documentation as it relates to your income, your assets. The lender is reviewing your credit history as well as any other monthly debts that you have. And an underwriter is saying upfront, yes, this loan is good. We will do a loan on this person, right? So when you have a pre-approval and it's fully underwritten, you have kind of a I don't know, 2 steps above other offers, just in the sense that on the contract, when you offer for a property, there's a couple of boxes that says, is this borrower pre-qualified, pre-approved, or fully credit pre-approved? So if you can pick that last box, which you have the ability to do, if you plan ahead, then you're going to be ahead of the game. Now, in terms of being ready to get pre-approved, you want to have kind of your ducks in a row in the sense of meeting with someone ahead of time, a lender, so that you can say, well, what is my credit? Do I need to improve my credit? Am I, credit worthy now? What are some of the ideas that you might have for that? I don't have a down payment. What assistance programs might there be? Let's get all that figured out up front, so you have confidence as a consumer that you know where you're going. Information is key. I mean, you and I spoke about that before we jumped on this call. You need to have information and knowledge to feel confident and to give yourself peace of mind that this is going to be okay. I want to get this house and I know I can. But so it's from the consumer's perspective, the borrower, but it's also from both the agent that you're working with, as well as the listing agent, the seller's agent, to know you've already got it all squared away.
Yes, ma'am.
With being approved, your numbers work for you, as well as the transaction. Your money is in the right place, your credit's in the right place. So that's the best way to be ready, I think, is to remove as many barriers to both your own, fears, but remove barriers to the offer itself by being fully pre-approved.
Yes. Okay. So I know I have, and I'm sure even more so for you, buyers that have been looking for the last 1 or 2 years have either now put themselves on the fence and they're not sure which direction to go due to the market changes, or they've just thrown in the towel and said, I'm not doing this right now for the foreseeable future until they think, it makes sense to them. What would you recommend to those individuals to consider and to look at before making the decision to postpone?
Yeah. So there's a couple of pieces there. I mean, one, it might be that given the current levels of values that you're looking at and the current levels of interest rate that you're looking at, that equates to a monthly payment that either you don't qualify for or you just don't want to have.
Right.
There's that. So maybe you do have to take a step aside.
Yep.
But I will say that you also want to really look at what is the cost of waiting. If home ownership is still such a an important piece of anybody's financial future in terms of, building their own wealth base, not paying someone else's mortgage, paying your own through appreciation, through amortization. You're making a monthly payment every month. So over time, your personal wealth will grow by purchasing a home. So what those people that, yes, I do eventually want to buy a home, I'm going to wait. So there is a cost of waiting. And so even in our area where values might level off, or we're not going to go up by 20% next year, maybe we'll go up by 5%, even if it calms down a little bit, I can show you, I have a great little calculator that says how much money you would lose over the next 3 years, 5 years, through even minimal appreciation and paying down on your own mortgage. You're talking about, in some instances, $50,000, $100,000 that you've lost by not doing it now. Okay. That being said, there are some really cool ideas that are becoming more and more possible, I will say, to get your rate down into the 4s again. So I am working with someone right now, worked with an agent that was able to put in an offer, very competitive offer, but instead of, this property had been on the market for longer than usual now, like 2 or 3 weeks. And instead of going in with, well, let's offer $25,000 less than the list price, because it's been on the market for a little bit, so maybe we'll get a deal. It's a great idea to at least consider either list price or somewhere around there, but instead of negotiating price, negotiating a seller credit to buy down your interest rate. So I've got buyers that are right now in 4.75, but the true rate, had they not bought down the rate, would be about a point higher, about 5.75. So what we were able to do is, so that's not going to work on every instance, as properties are still super competitive, but that's one idea. There's a variety of other ways to establish let's get a better interest rate now. But at the end of the day, what we've kind of got this battle cry, it's out there in memes all over the place. So it's not like I created this, but it's basically, you love the house, marry the house, but date the rate. So you're dating, you're using, you're getting in under this rate. It's not what you wanted. You're kind of grumbling about it, but recognizing kind of what I said at the beginning of us chit-chatting is, more than likely, we will see lower interest rates in the not too distant future. I mean, I'm not the, fortune teller on that. Anyone can kind of pick up any mortgage news digest and be able to see, basically repeat what I just said. We're probably seeing better rates, lower rates next year. If you find the house you like and you can afford to make the payment and you qualify for the payment, don't cry about being in the 5s, because you will probably be able to refinance and date. So get rid of that person, get rid of that rate, but you got the house today.
Yes.
Which more than likely next year in our area, Central Coast, will be priced higher next year. Might not be that much, but it might be that much. So really, it's like kind of this, I almost called it a hamster wheel. So you're constantly running. You're like, oh, well, maybe rates will come down. Maybe if you're waiting, maybe values will come down, but they don't. And even if rates do come down, values still went up. And even, so it's always a good time to buy now if you can afford the payment and you qualify for the payment.
Okay. Yeah. Agreed. Fully agreed there. Do you have anything pertinent that you want to add, or another?
Well, I mean, maybe you can just share what you're seeing, because I know that you work with buyers as well as sellers. I mean, what are some of the most important things you feel, for buyers? What are you looking, when you're a seller, a listing agent, what are you looking for when you have 3 or 4, I mean, assuming one of them's not all cash, what are the things that you think are most important in offers if you've got a competitive situation where there's 3, 4, 5 offers for the same house? You're the listing agent. Obviously, you're presenting it to your seller. It's not fully your decision, but what are some of the most important things that you look for?
So a few things. I'm going to look at earnest money, which is the amount that the buyer is willing to put up to show their good faith deposit. And which would mean that if the buyer were to default later on during the escrow process or outside of their contingency period, that the seller would get to keep all or a portion of that deposit as damages.
Mhm.
That is important when you're looking at multiple offers. Typically standard is around 1%, but in this market, we've seen that go up and up, just like everything else, 3% or more on that. So we're going to look at that. That gives the seller some assurance. Definitely going to pick apart financing. I'm going to call the lender if I don't, especially if I don't know them, but just to verify everything, see where that particular buyer is at in the process. If there's any concerns or, if they need more time on something, we want to know all of that up front. Going to look at, and really a lot of it too is specific to the seller and what they're looking for in their situation. But I think financing, deposit, are they touching contingencies as far as shortening them up or waiving them? That's all important to look at.
Yeah.
And then the rest is just situation specific.
Yeah.
But
And then
those
the
are big
numbers,
things.
right?
Yeah, exactly.
Yeah.
Yeah.
Oh, yeah.
I
So
mean,
yeah,
price is important, but it is not everything. I mean, you can throw, people not as it's calming down now, but for a couple, 2020, 21, people were just shooting for the stars with their offers. And it's like, do they, is there any backing for this price whatsoever? Do they have money to cover if it doesn't appraise? I mean, all of those things are, you got to sort of pick apart and strategize before accepting anything.
yeah. Yeah. Sometimes it's too good to be true. It is, right?
Yes.
I mean, what do you see as far as the real estate market and values over the next year or two here locally?
Staying strong, not going down,
Yep.
probably going up. We saw some pretty astronomical increases the last couple of years. So maybe, between 5 and 8%,
Yep.
which is, much more modest, normal appreciation. So yeah, not going down. And again, and some regions may see a decline, but again, going back to just where we live and how strong the demand is, and a pent up demand. People have been looking for 2+ years to get their foot in the door here and haven't been able to. So it takes a long time to work through all of that. I think COVID with, the COVID restrictions that the Bay and LA area and, even other states saw made people look at moving elsewhere. They can work
Yes.
from home. They're over it being indoors and being restricted. And, it's a much more small town, and just an all around attractive place, regardless of where you're at in your life, what age there's something for everybody here. So,
Yeah, I definitely saw that the same. And we just haven't really had any large scale buildings. So there's just
right.
in our area. So there's just not enough, houses inventory for as many people that want to live here. So this laws of supply and demand are just always, for many years to come, are going to be in play, because there's this whole demographic of my age and older that want to come here to either have a second home or retire or whatever. Right. So that's been going on for a long time now, but now we have a whole nother demographic because of COVID. We can work from home forever. So why do we want to live in San Jose? Right. I don't know. I don't want to live in San Jose. Let's live in darn near paradise, Yes. So now we've got that group of people that are, which is nice. I like being able to, like you said, having a variety pack of a community. That means all different types of people, ages of people. That's a good community. So that's nice.
Yes.
But like you said, that makes it competitive in the housing market for some time to come.
Yes, they're selling, big, the markets up, down south and in the Bay is even more insane price wise. So they're cashing in on some big numbers up there. So it's making things even more competitive here. So I definitely do not see that changing anytime soon. It's going to be.
Yeah. So basically, marry the house.
Yes, ma'am.
Great.
Yeah.
And I'll be here for you next year when we want to refinance. Yes. No problem.
Yes. So if anybody has any questions or they want to start the approval process, what's the best way for people to get in touch with you? And I'll post it too, but.
Yeah. So Zoe Raithel, Cross Country Mortgage. My phone number is 805-400-8585. And that's probably the best way to reach me. And then we can start a dialogue on and connect on which is best for you as a buyer to meet in person, Zoom, phone, we have obviously all kinds of mobile tech, tools to apply online, whatever. I like to be able to offer whatever works best for the buyer. So
Okay, excellent. Well, thank you so much, Zoe. This was
thank you,
fun.
Amber. I
It's
really
fun.
appreciate you taking the time with me.
Absolutely. All
All
right.
right. Take care.
All
Talk to
right.
you soon.
Sounds good.